Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I'm your host, Evon Mindrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. If this is your first time listening to the podcast, welcome aboard. On today's episode, I am joined by a very special guest, fellow financial advisor, Andy Panko. And Andy and I dive into a very specific topic, the indexed universal life insurance product. And the reason I wanted to dive specifically into this particular product, the IUL, is because I've just seen an explosion on social media and the internet and YouTube of marketing and sales about this specific product as the be-all, end-all of financial products. And so many of these videos are full of inaccuracies, are often incomplete, or simply just false or misleading, or at worst, giving just terrible financial advice. So I wanted to have a podcast episode specifically on this so that you, optometrists, can be better informed and better educated when you are presented with a solution like this, and so you can make better decisions. Ultimately, hopefully you have a third-party objective financial advisor in your corner to walk through these decisions with and review these contracts with you. But if not, hopefully this podcast episode is helpful for you. And so Andy and I dive into the nuts and bolts of these IUL products. We dive into how they work. We dive into the positive aspects, the negative aspects. We try to separate out fact from fiction about these products and how they're marketed. So hopefully this is helpful to you. If you have any questions, please reach out to me, Evon, E-V-O-N, at optometrywealth.com. You can check out all of the links and resources we talk about in the episode on the show notes, which you can find at the Education Hub at my website, www.optometrywealth.com. And while you're there, feel free to schedule a no-commitment introductory call. We can talk about whatever is on your mind financially, and we can talk about how I help optometrists all over the country navigate decisions just like this and more. And with that, without further ado, here is my conversation with Andy Panko. And welcome back to the Optometry Money Podcast. I am your host, Evon Mindrin. And on today's episode, I am excited to welcome to the show fellow financial advisor, Andy Panko. Andy, thank you so much for coming on.
Thanks, Evon. I'm super happy to be here.
Well, I've been looking forward to this conversation to dive into one specific financial product, and that is an indexed universal life product. And while the listeners may not be as excited as I am, if you've been listening over the last couple of episodes, we've been sort of going through a life insurance theme. And starting out a couple episodes ago, I just gave a broad guide for optometrists about life insurance. Last episode, I had an insurance broker on. We dove more into the ways that permanent insurance policies work, ways to adjust them. So more on those particular type of policies. But today I want to hone in on one specific type, excluding all the others, and that's indexed universal life or IUL. And the reason I want to dive into this particular product is because I feel like I've seen an explosion of, over the last 1 to 2 years, just an explosion of marketing online, on social media, all platforms, on YouTube, marketing and selling these particular products. And in a lot of cases, I guess I can't say all because that would be unfair to truly transparent, honest agents out there. But in a lot of cases, what I'm seeing is that the claims made about these policies, about retirement accounts, about tax laws, about all sorts of financial concepts, the claims that are made are at times incomplete, at times misleading, inaccurate, at times just truly mind-boggling, and at other times, in the worst-case scenarios, like actually giving advice to do things that I think you and I might say objectively are not in the viewers or readers' best interest. So, and recently I've seen that come up on a popular video platform for optometry. So I wanted to dive into this concept a lot more so that the listeners, if they don't have a trusted third party to help make these decisions, at least they can be equipped when viewing something like this to make an educated decision. So with that really long-winded introduction, appreciate you, Andy, for coming on. And I wanted to have you on because I know you've done recently a pretty deep dive into these policies. You've very publicly purchased your own as an experiment. So you've been very vocal about some of the facts and myths about these policies. So just give us a little bit of a background. Like what is your background? Why are you interested in this? Tell us a little bit about yourself.
So I've been in the industry 23 years at this point. The first 19 were in corporate and institutional investment management, risk management. I did spend a few years at a large insurer, my first job out of school, where I did a few different roles on a kind of rotational program. One was an actuarial role, doing valuation of some of their products. One was helping manage their general account. One was securities lending, and one was credit research for private placement investments they were doing. And then after that was most of my career was in financing and doing due diligence on hedge funds and private equity funds. Also a few years of prime brokerage. So very in the weeds with lots of aspects of investments, investment products, insurance products, and really understanding the meat and potatoes behind them, how those companies work, how their products work, et cetera. Was never really fully satisfied or fulfilled in that work. Made good money, saw some tremendously cool deals and things and products, but always had this itch. I wanted to work more with individuals, feel like I'm making more of a difference. So always sort of wanted to be an advisor. Actually tried to be while I was in college. I graduated college in 2000, went to school for finance, and the places that were interviewing on campus for quote unquote financial advisor roles were, I won't name names, but a few large national insurance companies, one of which was a really big multi-level marketing structure, and a few wirehouses, the large broker names, household names everyone's heard of. And quickly realized they were either just 100% commission to sell insurance or commission to sell mutual funds with loads, commissions on them, or just asset gatherers where the model is all about get assets to manage, charge 1% or whatever the fee is on it. None of those seemed like or were like about the giving of actual advice. It was selling product. It was gathering assets. And I was like, this doesn't seem like what I thought financial advisory business should be. So I kind of gave up on the idea in college and then kind of stumbled into that insurance job and parlayed that into the rest of the experience I talked about. But 2016, I sort of had this epiphany. I was helping my mom make her Social Security claiming decision, which I didn't know much about. I thought Social Security was a forced savings account the government set up for us. Come to find out, it is very different than a forced savings account. But in the process, I learned a ton about Social Security, and it really sort of like the proverbial light went off over my head. Like, yes, this is what I thought the giving of financial advice should be back when I was in college 16 years prior. How can I do this as a job? And so from that point forward, just started researching what it takes to be an advisor, but wanted to do it my own way, my own terms, work with who I want to work with, charge how I want to charge, et cetera. And so I just started digging. Came across the XY Planning Network podcast. I don't even know how, but I did. And it just blew the lid off for me. Like, wow, there are other ways to set up a firm, to run a firm, to offer services, to charge for those services, et cetera. And that was it. I was in. So the next 3 years from 2016 to 2019 was a multi-year journey of reading and listening to everything I get my ears and hands on, podcasts, blogs, whatever, taking tests, getting the credentials. I got the CFP while I was still working in my old institutional world. Got the enrolled agent, IRS enrolled agent designation, and retirement income certified professional. So all those things were ready, lined up. November 2019, I finally left my old job and started my thing from scratch and my advisory firm, and went much better than expected, thankfully. And here I am a few years later. So bringing this all back, I work with retirees, traditional retirees, pre-retirees. And so I see them in the circles I'm in, like you said, over the few years, an explosion in people selling and pitching indexed universal life insurance as the sort of panacea to anything you could possibly need financial. Yep. Use it instead of other traditional accounts, et cetera, mainly aimed at saving for and living in retirement. So I saw a lot of it and it sort of piqued my interest. I knew at a super high level what IUL was, but never really knew it under other marketing names. I've since seen it called Laser Fund, Section 7702 Plan, Private Reserve Account, Tax-Free Retirement Account, handful of other things. And the more I researched all these names, I realized that they're all just pointing back to an indexed universal life insurance policy. Yeah. So it got me thinking. The more I thought about it, the more I dug, the more I tried to learn, the more I came across more pitches and just really found some folks I'm convinced are intentionally nefarious about how they're pitching it. Others are just clueless and don't know any better, which is almost as dangerous. And how they're pitching this, what I consider to be one of the most, if not the most, complicated financial products out there. And I just felt I need to more understand this. I don't want to just write it off, right? But I do want to understand it well and be able to give a fair assessment, not just to people I work with, but also the public, because I feel like people are going to get fleeced by this. And there doesn't seem to be a lot of regulation around it, or at least if there is, it's not enforced. So I kind of took it upon myself to try to tactfully bring attention to and or call out what I see as incorrect, misleading, half-truth pitches about this stuff. And they've often gotten contentious, these back and forths I've had with people on LinkedIn, on Facebook. And people tell me, you don't know what you're talking about. So I was like, okay, let me actually buy a policy that claims to be properly structured, properly funded, to work as advertised, and then just follow it myself. Because as you know, insurance is a private contract between buyer and insurer. There's not good sources of reliable data about how has the product performed, or is it going to do what it's sort of billed to do? We don't know. So let me get my own policy. You referenced it. I bought it. I made it publicly available. All the documents are available on a website I made for it called theiulexperiment.com. Go check it out. You can find every piece of the policy there. And I'm going to chronicle it throughout the years to see how is it actually performing relative to how it was sold when I bought it, which was only December 2022. So it's not that old yet. But that's where I'm going with it. Now, it's going to take multiple years for me and the people following to know, is this thing actually working as intended? So no conclusions could be made yet, whether or not, it's good, it's not, or it's holding up as sold. It will take a while, 5 years, 10 years, if not more, to really know how this thing manifests and plays out.
Interesting. We will all keep watch closely in eager anticipation. But my earliest couple years in my career were at one of those companies that you had seen when you were trying to get into this profession, and I saw all of the sales training. I saw all of the product pitches. I sat down with all of the agents and advisors in a room and heard the wholesalers pitch their version of exactly the same thing that we're seeing now pitched to the public. And at the time, at least the company I was with, it was variable universal life. The IOL was just on the shelf just to say they had it, I think. But that was the thing at the time. That was the hot item that solved all financial planning issues, retirement, tax planning, world hunger, whatever it may be. That was it. So I remember sitting down with professionals in a room with wholesalers and hearing these oversimplified comparisons between these products and other things, never seeing an actual mathematical comparison. It was just sort of these high level, bullet points. And I'm not sure that the professionals in that room really knew how to evaluate that product or the ins and outs of that product and compare it to everything else, all the other alternatives. Right. Now I'm seeing similar things on social media and the internet to the public with one of, like you said, the most complicated financial products, not just insurance contracts, but I think we would say financial products on the market. And I don't know if a consumer has a chance to really know what's happening in that product or what to make heads or tails of it.
No, absolutely not. And to be fair, the insurance companies aren't trying to be underhanded. These things are, all the details, all the risks, all the terms and conditions are fully disclosed in an often 50-plus page, policy, inclusive of the riders and stuff. So it's truly buyer beware. The insurance companies aren't lying. Salespeople might be twisting things when they present it, but the product isn't a scam, to be clear. The product isn't bad per se. It's not a scam. There's none of that. But the average consumer, even the above average consumer, will never fully understand or appreciate exactly how the product works, exactly how it can change, exactly how it can play out over the decades you potentially own this thing. For better or worse, the person who buys it is going to mentally anchor and have their expectations anchored to the illustration they were shown when they bought it. And chances are, in my opinion, I can't prove this, no one can prove it until we have the benefit of hindsight looking back, there's 3 columns in most illustrations. One is like how the absolute worst this can do if you hit all the minimum level of guarantees. In that case, these policies, most of them are going to lapse pretty quickly. Rightfully so. Anyone who sells it will be like, don't pay attention to that. That's a possibility, but it's not going to happen, which I agree. That's the most sort of extreme case that is almost certainly not going to happen. The next column will be, or the far right column will be the sort of maximum rosiness that the regulations will allow to be shown for this product. And it generally involves a return of like 6-ish% per year on, the interest the policy is going to get. That's what people are going to anchor to. And that's going to show this too good to be true story of I put in X amount of dollars for Y amount of years. And by the time I'm 60, I'm going to be able to take out buckets of tax-free cash flow. It's technically loans, but buckets of these loans for the rest of my life and not have to repay them. Could that right column, could that projection manifest itself? It is possible. I see how it can. Is it likely to? I'm convinced it's not likely. And then there'll be a third column in the middle, which is like somewhere in between. Better than the absolute worst case, not quite as rosy as what they're showing. And in that scenario, the product doesn't look too great either. Not terrible, but it's not nearly as good as the column that they're going to have you focus on. So point is that there's lots of ways, and we can get this if you want to, this level of detail. There's lots of things the insurer can change. There's lots of ways in which that best case scenario isn't going to manifest itself. But consumers don't know that. And most people, unless they're an engineer, an actuary, an accountant, and finance professor, and a lawyer, they're going to have a hard time fully reading and understanding everything that goes into this policy. Yeah. It's not their fault. It's just the product's that complicated.
Right. So let's dive into this one step at a time here. I think just to sort of set the foundation, Andy, I think you and I would both agree life insurance is an incredibly important part of anyone's financial plan, just as a general
100%
general rule. I think it's, as you mentioned, I think you described it perfectly. These are just products, right? They aren't good or bad, good or evil. They are insurance products, they're insurance contracts. Every product has a use somewhere.
Yeah.
Some products have more uses than others. But at some point, every tool has some sort of use. I think our problem is how these products tend to be sold and marketed, right?
Yeah,
I think that's ultimately what it comes down to. And so hopefully this conversation gives the optometrists out there an awareness of how these things are sold and marketed so that you can scrape away the fluff and just see it for what it is and make an objective decision there. So let's talk about the basics here. What is an indexed universal life policy? What is it? How does it work?
All right. So I don't know how in detail you got with the previous episodes, but
I
with
saved
life insurance,
the deep details of this product for you, Andy. So I'll dive in.
All right. You kind of have to step back and give a super high level summary of life insurance as a whole. There's two broad categories, term and permanent. Uh-huh. Term, probably everyone knows. I won't belabor it too much, but term is you buy, let's say, $1 million of death coverage that's going to last 20 years. Your premium's going to be fixed. Let's say it's $1,000 per year. You're going to pay $1,000 per year for 20 years. If you die during those 20 years, your beneficiaries will get paid out $1 million tax-free to them. At that point, policy's over. There's no other requirements of you or your beneficiaries. They get paid out, policy done. On the flip side, if you don't die during those 20 years, policy is also over. You stop paying in, but also there's no more coverage. You're out of life insurance. So term is good when you have sort of a finite, defined, observable need for insurance. Typically younger folks who have young children or a house that needs to be paid off or loss of income if you were to die prior to retiring. That's generally a good reason to have term insurance. Then there's permanent insurance. Permanent, as the name implies, lasts your whole life. Now, technically, some older policies actually stopped at 90, 95, but generally speaking now, any quote-unquote permanent policy you buy is going to last until you're 120. If you actually make it to 120, the policy self-surrenders and it's done, but good for you. You already won if you're that old. So permanent coverage, the death benefit lasts until you die, or if the policy lapses. And I guess we can get on what it means to lapse, but let's assume you keep paying as required to keep the policy quote unquote in force. You will have permanent coverage until the day you die, all the way up to age 120. So now within permanent life insurance, unlike term, there's the ancillary benefit that the policy can earn and accrue some cash value. What that means is every dollar in premium you pay into a permanent policy, some of it goes to pay for the actual cost of life insurance, because these are first and foremost life insurance products. They're not investments. They're not savings products. Some of the money you pay goes to pay for the actual cost of insurance. Some goes to pay for commissions and fees and other sort of admin charges that the policy may have. Technically, well, not directly commission. I should step that back. But there's some of the fee goes to indirectly pay commissions. Leave it at that.
Yep.
And then the rest of the premiums that didn't go to costs and expenses go into building up cash value within the policy. That cash value can grow, it can go down over time. You can distribute it if you want. You can outright take it out, the amount of cash value you have, or you can take loans against it. And like any form of loan, whether you're borrowing against your house, you're borrowing against a brokerage account, you're borrowing to buy dinner on a credit card, the proceeds you get from taking a loan is not taxable income because it's not income. It's debt. It's borrowings. Borrowing against a life insurance policy is no different. That's why the money you take out of these policies is often called quote unquote tax-free because you're just taking a loan. Ultimately, you're not actually distributing it. So that's the cash value component. Now, here's where it gets tricky. There's different structures and ways in which your cash value can grow or get credited interest. One is a whole life policy, which is pretty plain vanilla. I mean, there's still some opaqueness to it, but more or less you're going to get a fixed rate of interest paid every year on that cash value. It's going to go up by that much, and then your premium is going to be X amount of dollars every year. So the cash value growth is going to be pretty stable, pretty predictable over the life of the policy, assuming you don't stop paying or pay less into it. Then we have universal. Universal, the cash values can go up or go down, and the method by which the cash value gets accrued interest can happen in multiple ways. One is variable, where the money is actually invested in mutual fund-like products, stock market type products or bond market type products. And so your cash value is going to go up or go down by whatever investment return your investments make within that variable universal policy. There's traditional, just called universal life, which is in effect a fixed rate of interest, where the cash value goes up by some fixed stated rate of interest every year. And then sitting between those two is what's called indexed universal life. The interest you get credited will never be zero or never be less than zero. It can't be negative, unlike variable life where it can go down. It can never be negative. It's only going to be something positive. But it's not fixed like in traditional universal. Instead, the interest you get is indexed off of some financial market index like the S&P 500. This is where it gets complicated. You don't just get, unadulterated, whatever the return of the S&P is, you don't just get that necessarily. There's something called caps and participation rates. I'll try to give a quick example. A participation rate of 100 means whatever rate of return the S&P gets, you will get 100% of that credited as interest. Subject to, gets a little technical, but you do not get the benefit of any dividends paid on the S&P 500. You only get the benefit of any price changes. So participation rate will mean 100% of the gain, price change gain of the S&P 500. Then there's also a cap oftentimes. A cap is subject to some limit of X. Let's say your cap is 8%. That means you're going to get whatever the S&P gets, but capped at 8%. You'll get no more than 8% interest. So never less than zero. It's going to be something positive and could be anything in between, any near zero to something positive. That, in a nutshell, is indexed universal life. I'll pause there for now.
So, yeah, I mean, I think when people hear indexed, they think it's like index funds, right? Index funds are good. They're invested in the index. They're going to get the growth of the market, whatever it is. But these particular policies are not actually invested like they would be in a variable universal life policy. It's
Correct.
The interest that's credited to the cash value is determined by the price movement of some index. And it can be something well known like the S&P 500. It can also be, from my understanding, an obscure proprietary index created by the insurance company, essentially, correct?
Those are the latest and greatest for regulatory reasons mainly, but yes, that's correct.
Okay. So
I'll
there's
explain what I mean by that. But
yeah, so there's different indexes that they will tie the interest that's credited to.
Correct.
And as you mentioned, Andy, you're not necessarily going to get the full price increase in good market years because there's going to be either percentages that you'll participate or certain caps that they're going to cap you at. And the insurance company, I'm assuming, will just keep the rest of that return for their own assets. And however, you have a 0% floor. And that's a lot of the times where the selling point comes to is that if the market, if there's a price decline in that index, your index life cash value is not going to decline alongside of that due to the performance. There's going to be a 0% floor where no matter the decline of that index, you're not going to see a decline in value due to the performance of the index. a good summary of kind of everything you mentioned there?
Yeah, just one thing I would clarify. You mentioned that you get capped out on your interest that you get earned. If the index earns more than that, you sort of reference the insurance company keeps the difference.
Yes.
Not actually the case. So this is where it gets really technical, and most people who sell it don't understand this. But the way that the insurance company gets exposure to the index to pass through to you the interest you're ultimately going to get is they buy options on that index with some of the money that you pay in premiums. So if the index goes up in value, the option pays off, and they pass that payoff through to you as interest on your cash value. If the index goes down and the option expires worthless, in option speak, you get zero interest from it. So there's really not excess upside the insurance company skims off or keeps. They're really just passing through to you the economics of the options they purchased with your money.
Got it. Also part of why you're not going to get the dividend portion of that return, because
that's exactly why. Because the option, 100% options are based on the price of an index, not inclusive of the dividends of an index.
Got it. And then how are they able to support the floor? Is it due to their investments in a general account? How does that side of it work?
Correct. So for those who probably don't know, general account is simply the huge pot of money an insurance company has that they throw into investments. It's often bond investments, corporate bonds, municipal bonds, government bonds, mortgage-backed bonds. Majority of insurance companies' products, behind the scenes, the money's getting invested in their quote-unquote general account. Index Universal Life is no different. So basic numbers, for every $100 of premium you put into your Index Universal Life insurance policy, $95 of it will get invested in their general account, where it's going to earn some relatively known rate of interest, let's just say 5%, I don't know, give or take. The other $5 of premium that was not used on the general account is going to go to buy an option. And let's say that option costs $5, the option on the S&P 500. So right off the bat, that $5 is a loss. They paid $5 to buy that option. But the $95 they invested in the general account is going to generate $5 of interest. So that's how they can guarantee you'll never get less than zero. You lost $5 from buying the option, but you're going to get $5 in interest from the $95 invested in the general account.
Got it.
That's your zero. And if the option does expire, with value, the option makes money. That's how then you get your positive amount of interest paid to you on your cash value.
Got it. Much more complicated than simply investing in an index fund.
So, it is, yes.
So when you're looking when you're looking at an illustration, which is sort of the projection of how this contract might unfold, both, as you mentioned, there's a guaranteed side of that ledger where based on the contractual guarantees, and then the hypothetical what could happen. And you've got all these different parts that sort of determine the crediting to your cash value each and every year. And in an illustration, you might see that as a static, those numbers essentially going static throughout the life of the contract. Can all of these different parts of this return calculation change? The cap rate, the participation rate, how can those variables change over the life of the contract?
They absolutely can, and they absolutely will. So like you said, the illustration is going to show a constant annual growth rate of generally 6%, give or take a little. 6% of interest every single year in your cash value without fail. 6%. Compound it another 6% more. Compound another 6% more, etc. In reality, you're not going to get that. There will be 0 years. There will be years that are much higher than 6%, and everything in between. The levers that can be pulled are there's interest crediting segments. Typically, it's a year. It could be longer, but let's just assume every year is what they measure your, the options and how much interest you're going to get credit on your cash value. Let's just assume they're all 1 year periods. When you enter that first year's crediting period, the cap rate and the participation rate will be known. They cannot be tweaked within that year. So wherever the index is going to do, it's going to do. Apply your participation rate, cap rate. That's your interest. And now when that year's over, you get your interest credited, if any, 0 to positive. Then you start the second year's interest crediting period. When you restart a new crediting period, the caps and participation rates can be changed. It will very clearly say that in the policy. Now, there will be some guaranteed levels that can't be changed beyond. So, for example, maybe you start your policy, you're getting a 10% cap rate on your interest. The policy will say the insurance company guarantees it will never go below a 5% cap rate. So any given year, your cap rate could be 10 or higher, or could be as low as 5. But year to year, yes, it can and will often change. Now, it's not changed for underhanded, sneakily reasons. The insurance company's trying to tweak itself some profit. Like I said before, they don't really profit off the options. But those caps and participation rates change because of the dynamics of the option markets. As options become more expensive, they will need to change those rates because they can only pass through so much to you because option costs go up. And I don't want to get into why option prices change, but that is a factor that can and will impact these things over time. Yeah.
Got it. Yeah. So the changes in these variables will just reflect the economics of the insurance company providing these policies, and not due to an underhanded reason. It's just a part of what they need to do to provide the policies over time. And so when you mentioned some of the ways that when you're paying these premiums, part of that's going to go to the cash value. What are the expenses within this policy, right? So you're paying for this insurance. It is life insurance first and foremost, right? So you're essentially paying for life insurance. So as you pay your premiums, where do those premiums dollars go, and how do the expenses work within a policy like this?
So everyone pay attention. This is exceptionally important. Any permanent life insurance policy can never be fairly compared to a traditional investable account, whether it's a 401k, an IRA, a brokerage account, whatever. They're fundamentally very different. In this case, life insurance is first and foremost life insurance. There will be costs associated with it, as there should be, because it's life insurance. So what are those costs? So just stepping back, one of the sales pitches I often see is that IULs cannot lose money. Mm-hmm. That is not true. It's true that the interest credited can never be below zero, but there will still be fees to come out of it, again, as there should be. Those fees can substantially reduce your cash value. So what are those fees? The big one is the cost of insurance itself. Again, you're buying permanent life insurance. So with index universal life insurance, what's technically happening behind the scenes is you are buying a 1-year term insurance policy every year. And then every year, you're just renewing that 1-year term insurance policy, and you keep renewing it year to year to year to year, all the way up until you die or you reach 120. Because of that, the cost per unit of insurance, per $1,000 of insurance, will go up every year as you age. Because think about it, if I'm a 45-year-old male, the chance of me dying in this next year is lower statistically than me dying when I'm 46, which is lower than me dying when I'm 47. So rightfully so, the cost per $1,000 of insurance will go up as I age. So that's one cost, the cost of insurance itself. Next is in the first 10 years, typically there's something called a policy issue charge, or we go by different names. There's also a premium charge. Every year you pay premiums, you have to pay a premium charge. I think most of that, if not all of that, goes to the state regulators to cover fees that they impose. There's also admin charge, administrative charges. Those are typically a joke, $50 a year or something, often waived if your policy is over a certain amount. And then surrender charges. If you do cash out your policy prior to generally 10 years, could be more, could be less, surrender period, there will be a fee they apply at the time on you getting your cash out, your cash value out. So those are the big fees. The amounts all depend, and this is where the product gets complicated. I feel like I have to mention this because this is important, so pay attention. This is where some people often get lost. There's something called net amount at risk. This is where it's the dollar amount of insurance that cost of insurance is actually applied on. Net amount at risk is simply the face value of the death benefit minus the policy's cash value. So basic example, let's assume you have $1 million death benefit and you have $100,000 of cash value built up in your policy. What happens if you die tomorrow is the insurance company will pay out the $1 million to your beneficiaries, but they're only kicking in $900,000 out of their own coffers. They're really just giving you back, or giving your beneficiaries, that $100,000 of cash value in the policy. So the net amount at risk is at $900,000. That's the amount the insurance company is at risk of having to pay out if you die. So that cost per $1,000 of insurance is only applied on the net amount at risk, $900,000, not the full $1 million. And so one of the fundamental underpinnings of these policies and why the illustrations look so awesome over time, is that while the cost per unit of insurance goes up every year you age, the net amount at risk, the dollar amount on which that cost of insurance is applied, is projected to go down, 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 down till it collapses to like near zero. that's because the cash value is projected to just go up, 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 up every year,
Right.
thereby reducing net amount at risk. Where these things can go wrong is if and when, for whatever circumstances, you don't pay enough in, or there's like a string of really bad years in the market, or the insurance company, for whatever reasons they have, need to increase your cost of insurance, which they can. There'll be contractual bounds, but they can increase the cost, such that your cash value depletes faster than expected or doesn't grow as fast as expected, and therefore your net amount at risk grows larger than expected. And so the costs can really sort of spiral in these things, and that can really further hurt cash value, such that these things can kind of hit a death spiral's too dramatic of a word, but the point is that they can really turn out much less rosy than you were shown on day one because of these series of events.
Right, especially if you are either taking withdrawals or surrenders from the policy and or taking loans against the policy while these different variables are changing against you, not in your favor. And you mentioned some ways. So, well, I guess let's stay on the expenses here. So it sounds like the expenses are in the early years are really the highest, or potentially the highest over the life of the policy. I mean, you're seeing most of these expenses sort of stack up in these first 10 years or so, 12 years or so, as you hold the policy, and it's not until much later on where it sounds like you start to see those level off, and which brings up an important point. Like, this is a really long-term deal. Like, this is not a product that you're going to have for the short term. You need to be set that you're going to hold this thing through the life of the policy, especially like you mentioned, just purely surrender charges. A lot of the claims are that you have immediate liquidity within the policy, and in reality, you don't. You have liquidity for the net cash value or the surrender value, meaning whatever you can get out of the policy outside of the surrender charges. But you have those surrender charges to deal with. It's not like you put cash in a bank account and then pull out the cash. It's different. And a great point in that these are often compared to things like 401k accounts, and we can talk more about why as we get to that. These are apple and oranges comparisons, right? One is an insurance contract that is purely insurance first with an ancillary benefit of a cash value. The economics are totally different. The purpose of it, the entire goal of it, is totally different versus a retirement account, a shell of an account with different tax characteristics and advantages, potential fee ranges. You haven't even talked about how you've decided to invest the funds inside of the account. So these really are two very different things you need to compare, and it's not totally apple to apples, although they're often compared in that way. And in terms of the way you can get, let's just touch again on the way you can get access to that. You mentioned in two ways. It's either going to be those withdrawals or partial surrenders, and or you're going to take loans against the cash value. And the claim is, as you mentioned, the claim is that you can create, as I talked about, immediate, quote unquote, immediate liquidity and or tax-free income in retirement. But is that the case? Is it creating income that's actually tax-free in some sort of loophole in the tax code?
Could ultimately be tax-free in hindsight, not guaranteed to be. And I'll explain what I mean by that. But first I want to address the immediate liquidity thing. So that's one of those half-truths. You can get liquidity from your policy in two ways: actually distributing, taking money out, or taking loans against it. In my policy, for example, which is properly structured, maximum funded, and just to say what max funded means, that is a key consideration for these. Max funded means you're pumping in as much cash as possible, as the IRS will allow, for the level of death benefit you have. You can't put infinite amount of cash into these above and beyond the premiums required to support the life insurance. The IRS does set limits on how much you can put in. So if you're not max funding it, there's no chance it's going to perform like shown. So at a minimum, you have to max fund it. So anyway, even with my policy, which is max funded, I'm not breaking even in terms of surrenderable cash value until 10 years in. Wow. So to say I have immediate access, immediate liquidity, can't lose money, categorically false. Now, I was aware of that. I don't feel duped by it, but folks who give the impression that you can't lose money, whatever you put in, you can take out. Like, to me, when someone says can't lose money, immediate access, whatever, I think if I put in X, I can always take out at least X. Mm-hmm. That is not true with these. Yeah. So for pure distributions, no. In my case, it takes 10 years until there's enough surrenderable cash value to equal what I paid into it. But you can take loans effective immediately. And that's what the salespeople are inherently referring to when they say, immediate liquidity or access. Now, the amount you can borrow against isn't going to be the full amount you paid in, because again, some of it got shaved off for fees, as it should have. So again, it's not access to 100% of what you paid in day one, but you can take loans pretty early. However, the sooner you take loans, there's a cost for those loans, as there should be. Any loan from anyone will have interest. Borrowing against your life insurance policy is no different. So if you start taking loans right off the bat, that's going to hurt the long-term outcome of your policy, because you now have that additional expense, that interest expense coming out of your cash value above and beyond the normal cost we just talked about before. So that's going to really hamper the long-term projections of things that weren't factored in the initial projection. So that's the liquidity thing. So can they be tax-free income? This is sort of, I don't want to say semantics, but getting technical. It's not income, like I said before. Any source of borrowing or debt is not income. It's a loan. So it irks me when they call us income, but that's a bit, I don't want to say it's an unfair hang up, but that's a little too critical. Is it tax-free? This is a huge, it depends. It can be, but not necessarily. So there needs to be a lot of qualifiers and caveats when someone pitches it as tax-free income for life. So like I mentioned before, you're borrowing against your death benefit of this policy. So long as the policy stays in force, stays active throughout your life, and you do eventually die, the death benefit that's paid will pay off the outstanding loans. Whatever's left goes to your heirs. In that case, yes, all the loans you took during your life were not taxable at the time, nor are they taxable when you died. They're simply paid off by the death benefit, which is all tax-free to your heirs. Mm-hmm. That part is 100% true. So that's the genesis of the claim that tax-free income for life. But how and where could this go wrong? And there's a lot of policies that have gone wrong and are upside down now, especially last year where market was not good, so interest crediting was low. And those that were heavily financed, a lot of loans against them, loan interest rates shot up as interest rates went up so much. So these policies can get dicey pretty quick. How it could go wrong is you borrow a lot, and ultimately the cash value doesn't keep up with projections. Let's say you have 3, 4, 5 years in a row of zero or at least really low interest crediting because the markets or the indexes you chose didn't do well. Your cash value is gonna drop most likely year to year because the cost of insurance, the other policy fees might still be coming out, and your loan interest is coming out of that cash value every year. And so, as I mentioned before, the whole net amount at risk thing, the more your cash value decreases and the older you get, the larger the dollar amount of the cost of insurance is going to be, and that can spiral relatively quickly. So you can get in a situation where you borrowed a lot out of it, and for whatever reason, oops, the policy isn't going to be able to stay in force unless I throw more money in to keep up with the fees that keep coming out. You may have to end up surrendering the policy. And here's where it becomes taxable. If you have, let's say, $200,000 of loans outstanding and you only paid in $100,000 of premiums in total, you surrender the policy today, rip it up, policy's over, you walk away from it, it will be deemed as if you took a $200,000 distribution out of your policy. And with any cash value life insurance, if you ever distribute out more than what you paid in, the excess is all fully taxable as ordinary income. Not even long-term capital gains, which are tax lower, it's ordinary income. So in this example, the $200,000 of loan that's effectively forgiven is treated as $100,000 of it was a return of the $100,000 you paid in along the way. The other $100,000 is fully taxable as a forgiven loan, in essence, fully taxable as ordinary income. So worst case, these policies can, I don't want to say blow up, that's bombastic of a term, but can lapse, can be sort of forcibly surrendered, and the loans you took out could then become taxable at that point.
Got it.
So,
yeah.
And just to be fair, there are riders. There's something called the overloan protection rider that any properly structured policy should have. This helps to attempt to prevent this scenario I discussed where, you're 20 years down the road in this policy, you take out a lot of loans, oops, the policy doesn't keep up. This rider will kick in and basically prevent the forcible lapse. When it does kick in, what happens is you can no longer contribute, you can no longer take loans. Your policy just basically, you get some paid, what's called paid up life insurance, and that's it. Policy kind of rides itself out until you die at that point.
Got it. So in terms of the So there are ways to sort of protect internally by adding on these riders or features on the contract. And in terms of,
they're not bulletproof, but yeah, it helps.
Yeah, and in terms of the tax nature of all these different things is you can withdraw or surrender up to your own premiums, right?
Correct.
The amount that you've put into it. So essentially, you're just getting back your own premium dollars, after-tax premium
Correct.
dollars. No tax-free income there. It really is just you're returning your own dollars back to you. Then you can take a loan against the policy. But as you mentioned earlier in our conversation, debt, according to current tax law, is not taxable income in any form. Potentially forgiven debt is, but debt in general, you can take a debt against your house, you can get a reverse mortgage, you can borrow against a taxable investment account. All these different forms of debt will still have that same tax-free nature. It's debt. There is a difference in that you don't have to go through some rigorous underwriting to get it. You don't have to necessarily pay the debt back until death, assuming it goes as planned. That will come out of the tax-free death benefit. So it does have some unique features of it, but ultimately it's taking out debt, which in general is tax-free. So there are ways to get, I guess, cash out of the policy without incurring taxable income, but it's not necessarily this trick in the tax code where the income from this policy is excluded. Ultimately, if you withdraw the whole, all of the cash value and there is growth above what you put into it, that amount is just tax deferred. It's going to be taxed at that point. So interesting.
I think that's a more accurate way to frame it. It's actually insurance is tax deferred,
yeah.
and then ultimately tax free when you die and the policy didn't lapse beforehand. That's a more accurate and honest way to discuss it. Yeah.
And then in terms of the illustrations, and you brought up a good point we haven't touched on, is that the illustration is going to show you this sort of flat static return and this flat performance of all these different variables, but the sequence, the timing of these different returns actually matter a whole lot in this policy. If you're seeing if your index is going to see low returns in these early years when your expenses are highest, you should be prepared for your cash value to decline it, going through that, or at least not grow nearly as well as it's being projected. To be fair, I guess. So in that case, down the road, you may be prepared to put additional dollars into it to keep it from lapsing. So a really important point there. And that sequence of returns, I mean, you and I talk about this in terms of retirement planning and in other ways that we're talking about the way investments can unfold over the future. It's totally lost in this conversation when it comes to the marketing and sales of these policies. And it's really important there. There are some ways that it's marketed where you're actually financing additional premiums and putting it back into these policies, ignoring altogether all of these different ways that you mentioned that it could go wrong. So the timing of the timing of the returns of that index is really important to the way that this can play out.
You mentioned something important that regarding taking loans from a cash value policy, there's no underwriting. It is relatively easy, and this is one of the benefits of borrowing against a life insurance policy. It is quick and easy, all things considered, to get a loan against your policy, easier than getting a loan against a house where you have to go through this whole, inspection process and bank underwriting. Easier than getting like a student loan, for example, or a car loan even, or at least cheaper. The rates of interest insurance companies charge are generally less than what's charged for unsecured credit, like credit cards or even car loans. Generally, home loans, it could be a mix. Currently, insurance rates are a little lower, I think. But so there is that benefit to it, and I fully acknowledge that. Just to be fair, but there are risks and drawbacks that can come from it, as we've been talking about.
Right, and how would keeping all these different things in mind, like how should someone evaluate something like this versus the other potential uses of your premium dollars? Like how would you compare, knowing we're comparing different things, different accounts to insurance contracts, like how would you evaluate the differences?
It's really, really hard. It's just so different of an animal. I'm not saying it can't work as projected. I'm saying it's not likely to work as projected, but it can, hypothetically. I do think generally IULs and the performance thereof is not highly correlated to the stock market. I mean, depending what index you select and stuff, but your interest can't be less than zero, as we discussed. The interest you get is generally going to be correlated. Like if you're using the S&P as your index, of course, it's going to be correlated to some extent, but It's not nearly as correlated as other, risky type investments. So there's that. But because of all these other angles and twists and turns to it, because it is insurance, because it is highly complicated, there's just lots of ways that the ultimate outcome of this is going to be quite variable. And that's what I struggle with. And and people sell it will be like, well, it's not as variable as your 401k. Like, a lot of people sell IULs just used as an attempt to try to bash 401ks. Yeah, if you're invested in stock investments in a 401k, they will be volatile. They will go up. They will go down. They could go down a lot. Look at 2008, 2009. Look at 2022 when stock market was down, whatever, 30%, depending on the market you're looking at. I get it. But I say that's not as complicated as an IUL, because if you need to stop contributing to your 401k because you lose your job or you get cold feet about the market or whatever, you not further contributing isn't going to directly impact and worsen the potential outcome of what you already have in there. That's going to be dictated by simply however that's invested, whether it goes up or goes down, it's going to do what it's going to do. With an IUL, you paid in $5,000 or more. My policy is quite small. Most policies are larger. You paid in $10,000, $20,000 a year for 5 years, and you decide to stop for whatever reason. You lose your job or just what you forget. I don't know. You not paying more in is going to impact not just your returns going forward, but the outcome of the $50,000 you already paid in for the reasons we discussed. The fees are, So like for that reason, you can get almost more in trouble, at least relative to expectations. You can almost get more in trouble with an IUL than you can with traditional investable assets in a brokerage account, IRA, Roth IRA, 401k, whatever. So how do you analyze this and determine if it makes sense? So this isn't black and white. This is all sort of subjective, my analysis, but I think the average folk, the low to middle income folk, probably shouldn't consider this. If you do have a need for permanent insurance, well, let's start with that actually. Yeah. Term insurance we discussed, right? We know why you might consider that. You're young, you got young kids, you got college to pay for, you got a mortgage to pay off, you got loss of wages to cover. That's term insurance. Most people, in many cases, you get to 60-ish, kids are grown and on their own, college is paid off, house is paid off. You already stopped working, so you don't have to worry about replacing wages. There objectively isn't really a need for life insurance in many cases for people over 60-ish. When would you consider permanent life insurance? Put aside whether it's indexed or whole or whatever, when would you consider it? There's a handful of reasons where permanent insurance is the right fit. One is you have like a special needs child, for example, and you want to ensure there's money left to him or her when you're gone to help pay for the care they're going to need throughout the rest of their lives. Further complicated, that money should usually be left to a special needs trust, so it doesn't count against them for government benefits and stuff. But anyway, that's one. Another one is simply you're going to need liquidity in your estate upon passing. Let's assume you have a big estate, it's worth $10 million, but it's all tied up in a business. You die, you don't have, cash available to pay taxes on that or to pay estate closure fees or whatever. You may want some permanent insurance so that when you die, there's always some amount of life insurance that's going to pay out. Boom, here you go, pot of $500,000 of cash or whatever. That's another one. Another is like if you have a business and part of you and your partner agree that if I die, my partner's going to buy out my business. He or she may not have the few $1 million or whatever it's going to cost to buy me out. So they can get a permanent life insurance policy. I mean, when I do die, they get the cash from that policy. They can then buy the business out for my spouse or whomever. Another is, especially for higher net worth folks, tax efficient generational wealth transfer. So this gets a little technical, but there's something called the unified credit. Basically, how much money you can gift away during life or die with at death before the federal government charges your estate tax, or states as well can have a state tax. So one way to do it is you can slowly and methodically peel off large chunks of money while you're alive to pay into a permanent life insurance policy. That money leaves your estate because it's an expense. And you can have this life insurance policy owned by a trust that's not you, so it's not going to be your estate. So you can peel off money to reduce your estate while you're alive, put it into this, what's going to be hopefully a large permanent life insurance policy payout when you die, that your heirs then get all tax-free through this trust. That's another use. For average people, you probably don't need to consider that. Again, that's sort of the higher net worth planning angles there.
Right.
So those are the big ones. Why would you consider permanent life insurance? So if you meet one of those conditions, then start considering what's the best flavor of permanent life insurance to do it. Now it comes to like, what are your objectives? What other ancillary benefits are you trying to squeeze out of this thing? Are you trying to also use it as a cash accumulation feature to eventually take loans out of? If so, okay, now you start considering it. If you answered yes to that, now you have the choice, which flavor do I use? Do I use whole life, where we briefly touched on? The rate of growth is going to be potentially lower than an IUL, but much more stable. So do you want that sort of, a little more certainty? Do you want variable life, where you can really shoot for the stars with the growth because you can invest in actual securities, but there's much more downside to it? Mm-hmm. Or do you want IUL, which in theory sits in between, and it kind of gives you a bit of both flavors, but is also far from, risk-free? That's sort of the thought process around it. And then I think we sort of touched on, or maybe we didn't, but like I said, the masses, average folk, low to middle income folk, you probably should not consider this because, like I said, it does take a lot of funding to have a good chance of working. These policies aren't cheap, especially again, because you have to sort of max fund it to really maximize the benefit of the cash value. And you have to ensure you can keep that up. If you buy a policy where you're saying, I will pay in 30, 40, 50 grand a year for 10 years, you better make sure you're in a position where you can actually do that for 10 years, or you will be really, really let down with how this policy plays out.
Yeah. So important to note, you led with the risk management features of life insurance, because remember, this is life insurance.
Yes.
Right? If you have a permanent need to cover the risk of your death, whether through needing liquidity in an estate or estate planning needs, whether it's providing liquidity for special needs, whatever that is, or providing a legacy because you want a guaranteed legacy regardless of asset fluctuation, like you're starting with that risk management goal. And then you're
Correct.
using the ancillary benefits to do these other secondary goals that you have in mind, which is interesting because you talk about these things being properly structured. And when you think about if your primary goal is in fact the death benefit, you're probably wanting to fund this death benefit as cost effectively as you can. A lot of times that goes counter to the goal of overfunding it by building up the cash value. Whereas if you want to focus on building the cash value, you're actually trying to lower the death benefit as much as you can to make sure that the cash value grows as efficiently as you can. So it's an interesting dynamic in terms of how the policy is structured based on what you're trying to do with it.
It is. And I'm glad you brought that up. It really does fundamentally change how you view and how you use it. I did say, first and foremost, you should only buy this if you think you have a legit need for permanent life insurance. Right. Stop the conversation right there. That implies buy permanent life insurance for the lowest outlay you can, right? Which is probably whole life. That's the most stable, not the least expensive, but at least the most stable in terms of what to expect. If you do then want to go the route of, okay, I have this permanent coverage, but I also want to try to really wring as much as I can out of these ancillary benefits, that now is where you flip gears and say, I'm not just trying to put in the minimum to keep the policy alive. I want to put in as much as I possibly can that the IRS will let me for the death benefit. But once you go that route, you have to commit to that, because if you don't, you're in effect throwing good money after bad.
Yeah. That makes sense. And I appreciate you talking through. I mean, it's good to know, like, again, these are tools and there are uses for these permanent life insurance policies. There are strong opinions out there about you should never use them versus you should always use them. The right answer is somewhere in between. There are appropriate uses of these tools and there are not. And you just have to keep that in mind. Let's hit on a few. I want to play a game of fact or fiction here. I want to just quick hitters, touch on some common things that are said, and let's see if these are true or false here, Andy. So one of the most common things I hear to start out conversations about this is that 401ks are a scam and this is what the rich do. Fact or fiction?
Fiction. You want me to elaborate or just stop at that? I mean, I can go on for a half hour about this, but no. 401ks are not a scam. They're not the best necessarily. They're not the worst. Like anything, like any product, any strategy, they have their use cases, even if in limited doses. Like a 401k, if you get a employer match, that's free money.
Yeah.
No matter what you think about the 401k otherwise, that's 100% return on your money. Get at least a match. Whether or not you contribute more beyond that, it's a whole separate set of analysis beyond that. But 401ks are not a scam. There is no secrets. There's nothing hidden. I guarantee you the banks, the wealthy, do not care whether or not you know about IULs and whether or not you use them. That's nothing more than marketing hype, period, full stop.
Sometimes it's your accountant that doesn't want you to know about these things too. So there's a lot of people working against you over there. But yeah, I think that's a good point. A lot of times it's this scam part of it is 401ks are tax deferred, meaning you're getting a deduction. You're choosing not to be taxed on your income today in order for you to be taxed when it's withdrawn. And that tax deferral is often valuable. It's not the monster, the boogeyman that it's made out to be. If you're in your highest earning tax rates and you're expecting to be able to withdraw or convert those funds early in retirement at lower tax brackets, that tax deferral is valuable. And frankly, if you just hate that part of 401k plans, then there are Roth options in these 401k plans. Thanks to recent laws, by law, almost just about every retirement account now gives you a Roth option in some form. So you have the ability to tax your income and allow it to grow, assuming the rules are followed in retirement, and in retirement withdraw it tax-free. That ability is out there. So I think that's categorically false and it holds no water, but it's the first thing that's always said. Listener, if you hear that, without a doubt the next thing you're going to hear is a pitch for some product.
I'd also, just to be fair, anyone who says 401k is a scam, just stop and run away immediately. But the flip side's true. Anyone who says annuities are a scam, life insurance is a scam, stop and run away from that person immediately, right? Do not speak in absolutes like that. To your point, everything has its potential use case. Products aren't inherently bad. It's how and when they make sense and why, but they're not scams, right? So let's stop with that.
Something I've often seen presented on a whiteboard is that these life insurance policies, IULs, can produce more income in retirement than 401k accounts. Fact or fiction?
Oh, man. Those are based on massive amounts of assumptions, given the benefit of the doubt to the IUL over the 401k. I planned on doing a video about that, but just sort of lost steam. In a nutshell, the assumptions that they're making are that your traditional investable account, whether it's going to be an IRA or 401k, because they're going to assume it's tax deferred, they're going to assume you are only able to distribute 4%, using what's since been called the 4% rule. Now, this is where it's just fundamentally apples to oranges. Even the 4% rule is really just sort of a guess, right? We don't know how markets and portfolios will perform. For what it's worth, the study that since has been dubbed the 4% rule, in the majority of the cases over the history that went into that study, if you only took out 4%, you died with a lot more, or in many cases, you died at more than you started with, or at least you died with a lot. So 4% isn't the end all be all. It was actually sort of the most conservative based on historical findings. So that's sort of like the downside assumption. It's sort of picking the worst assumption for the traditional investable account. For the IULs, it's giving it all the benefit of the doubt. It's assuming that constant annual growth rate. It's assuming no changes in caps and participation rates. It's assuming no changes in loan interest rates. It's assuming that some tax rate it's going to assume for the 401k IRA, and it's not going to assume it's going to be 15%. It's going to assume something high, like 25, 30%, which might not be unreasonable. But and like we discussed before, there's just so many ways in which the illustration is not going to end up like shown. Could be better.
Right.
Could very likely be worse.
Right.
So you got to take those things with a grain of salt. If they play out as those assumptions hold to be accurate, sure, it works better. Will they be accurate? I highly doubt it.
Got it. Yeah. It's taking the very best possible assumptions of one thing and then it's comparing it to the absolute most conservative research observations about withdrawal strategies in retirement and comparing the two. I have an episode about the 4% rule. I'll throw a link to that in the show notes. But in reality, you can withdraw whatever you want from your accounts. There's no restrictions. Now, whether that's a sustainable rate of withdrawal, that's totally different. And that depends on a whole range of assumptions that are not even possible to add into a whiteboard comparison that you're often going to see. Absolute fiction. The other thing I was going to talk about is, can you get market returns without the downside? I think we've sort of debunked that already. First of all, you're not actually invested in the market. Secondly, there absolutely the way that this can unfold, depending on the timing of the way the index moves up and down, and all of these different variables that you talked about can provide a range of outcomes with the growth of these policies. But there is no cheat code to the laws of physics of investing, where in general the return you can expect is tied in some way to the risk you're taking for that investment. There's no cheat code to that. You're to increase your expected return, you're in some way going to increase investment risk. as a general rule, right? And if these IUL policies can break that physics of investing and allow us to get market returns without the downside, we would all be piling cash into it. I mean, I would have no reason to not do it for my own family and to tell all my clients to do the same, but there simply is no cheat code.
As with the insurance companies themselves, there's a reason they invest to get as good as possible, relatively conservative returns. They invest predominantly in bonds. Like I said before, corporate bonds, mortgage-backed bonds, treasury bonds. If IULs were that good with that little downside, such that you can get really ongoing, consistent, low volatility returns that are 5, 6, 7, 8%, insurance companies would invest in IULs, no?
Right.
No, a little trickier because as an insurance, right, you have to have an insurable interest to buy life insurance, so that sort of complicates it. But anyway, I agree with you. Yeah, there's no cheat code to getting better returns or really good returns without commensurate risk involved.
Yeah, and that claim is made across a wide range of different investment types, private equity, real estate syndicates. Just keep that in mind as you hear claims about better returns than with less risk than. Be really mindful that that's probably either not just simply not the case or misrepresenting the definition of risk, and you need to dive in deeper to that. Anything else that optometrists listening should know about these products? Keep in mind. Any last thoughts? We've taken a deep dive here, and hopefully it's more than enough information at least to set people on the right track and give them a feel for what the good and the bad is of these different policies. But what's some last thoughts you want to leave with the listeners?
Just my sort of anecdotal observations. The product is new. The first IUL came into existence in 1997. So take with a grain of salt when someone shows you, especially like buying one on kids. I saw a video recently. You can buy an IUL on your kids, start putting in $200 a month when they're 1. By the time they're 60, they'll have like $8 million or something ridiculous. There's no actual proof that these have worked like that over the course of 40, 50 years because the product's only 26 years old, if I did the math right. Yeah, 1997 to 2023. The last decade or so, post-financial crisis, has been the heyday of things going right for IULs to do well. And that's mainly kind of two things. In absolute terms, the stock market did really well in that time. Well, 2022 was a disaster, but up until then, really strong stock market returns, relatively low volatility of stock market returns. And volatility plays into option pricing. Low volatility means options are cheap, means you can buy more options, you can get more IUL interest. So that bode well for IUL returns. So to your point before, an explosion in sales and marketing of this, I think that's largely because using the last decade as an example, man, these IULs look too good to be true. What's to say that last decade's market conditions are going to hold going forward? So far, they're not, right? Stock market returns aren't going to be as good on an absolute level. Volatility has already been higher in the last year and a half or so. So that's why people are coming out of the woodwork to sell this, because the last 10 years were good for it. Mm-hmm. The next 10 years, next 20 years, probably not going to be as good. And so a lot of people will be let down with this. So that's not specific to optometrists, but I'm just saying I think that's why we've seen so much about this in the last handful of years. And exposure begets exposure. The more people selling this, the more interest you see drummed up, the more clickbait videos you see, more people come out of the woodwork to get involved and sell it because it's sort of the hot thing, the newest shiny object. So if something seems too good to be true, probably is. Yeah. If something is the product du jour, that alone should raise suspicions.
Right. Especially when it's presented as the one solution for all things. And unfortunately, with insurance in general, it's often sold in a way that ties to some emotion, some fear about something bad happening. And especially when there's an investment component tied to it, it's often now the fear of market downturns, the fear of losing dollars in retirement, the fear of tax law dramatically going against you in retirement, right? It's some fear. So keep that in mind. It's going to tug on a fear or concern that you and all of your peers are feeling during times where things are not as fun when it comes to your investment accounts or the way that you are invested. But hopefully this conversation helps you to think a little more rationally about the nuts and bolts about how some of these products works. And I'm sure we've barely touched the surface on a lot of these different parts of it too. I'm sure we can talk even more, but hopefully for you optometrists listening, this is helpful. Andy, I really appreciate your time today. This was helpful for me, and I think for the listeners, going to get a lot out of it. How can people find you, follow you, and learn more about what you're doing?
I would say the best place is probably retirementplanningeducation.com, which is not my advisory business. That's sort of a content creation sort of side thing I got From there, you can get links and feeds to my podcast by the same name, YouTube channel by the same name, and Facebook group by the same name. There's also a bunch of freely downloadable guides, cheat sheets, flowcharts, etc. You don't have to cough up your name or email. Just click download. There you go. Have at it. Lots of good stuff there.
Awesome. Well, appreciate it. Well, listener, appreciate your time and listening today. We will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mindren is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.